If you think index funds are a safety net, you haven't looked down lately, because the ground beneath them is shifting, and if you're not careful, you'll fall with the rest of the crowd. I've praised index funds for decades. I've recommended them to friends, family, and yes, even in my will. But today, I need to say something I never thought I'd have to say. They're not invincible. They're not immune to bubbles. They're not immune to panic. And they're certainly not immune to overexposure. When everyone owns the same thing and no one's thinking, you don't get safety. You get fragility. And fragility is what breaks when the pressure builds. Let's start with the basics. Index funds were designed to be simple, passive, efficient. They track the market. They don't try to beat it. They don't chase trends. They don't pretend to be smarter than the crowd. And for most people, for most of history, that's been a gift. They've democratized investing. They've lowered fees. They've removed emotion. They've allowed millions of people to participate in capitalism without needing a PhD in finance. That's a good thing. That's a powerful thing. But simplicity can become complacency, and complacency is how smart investors get blindsided. Because when you buy the index, you're not just buying great businesses. You're buying everything, the good, the bad, and the dangerously overvalued. You're buying companies with no profits. You're buying companies with no future. You're buying companies that are only in the index because they got big, not because they got better. And when those companies stumble, they drag the whole index down with them. Now, let's talk about scale. Index funds are no longer a niche. They're not a quiet corner of the market. They are the market. Trillions of dollars flow into them automatically through retirement plans, robo-advisors, institutional mandates, and that creates distortion, artificial demand, price inflation, fragility. When a company enters the index, its stock price often jumps, not because it got more valuable, but because index funds are forced to buy it. When a company leaves the index, its price drops, not because it failed, but because index funds are forced to sell it. That's not investing. That's mechanical momentum. And mechanical momentum is dangerous when it becomes dominant. Because if too many people own the same thing and no one's thinking, you get a herd. And herds don't think. They stampede. Let me give you an example. In 2020, during the pandemic crash, index funds didn't protect anyone. They amplified the fall. Why? Because when panic hits, people sell everything. And when they sell index funds, they're selling every stock in the basket, good and bad alike. That creates forced selling. That creates liquidity crunches. That creates systemic risk. And here's the irony. The very thing that made index funds safe, diversification, is what makes them dangerous when everyone owns the same thing. You're not diversified. You're diluted. You're exposed to every sector, every bubble, every mispriced asset. And you don't get to choose. You ride the wave until it crashes. Now, I want to be clear. I'm not saying index funds are bad. I'm saying they're misunderstood. They're overused. They're overtrusted. They were designed for passive investors. But today, they're being used by active traders. They were designed for long-term discipline. But today, they're being used for short-term speculation. And that's not the fault of the funds. That's the fault of the behavior. Because no investment is safe when it's used recklessly. No strategy is sound when it's applied blindly. And no asset is immune when it becomes the default. Let's talk about concentration. The S&P 500 is supposed to be diversified. 500 companies, multiple sectors, broad exposure. But look closer. The top 10 companies now make up over 30% of the index. That's not diversification, that's concentration. And most of those companies are in tech. Most of them are growth-oriented. Most of them are priced for perfection. So when tech stumbles, the index stumbles. When growth slows, the index slows. When sentiment shifts, the index shifts. And if you're retired or close to it, that's not a risk you can afford to ignore, because you don't have time to rebuild. You don't have time to wait it out. You have one shot to protect what you've built, and that shot is now. So what do? You think, you question, you diversify, not just across sectors, but across strategies, across time horizons, across thinking. You own businesses you understand. You own assets that produce income. You own things that don't move with the crowd, because when the index stumbles, you need something that stands. Diversification isn't about owning more. It's about owning wisely. It's about resilience, optionality, control. And control is the one thing index funds don't give you. They give you exposure, but they don't give you protection. Let me tell you something I've learned after 80 years in this business. The safest strategy is the one you understand, the one you can explain, the one you can hold through the storm. And if you're holding index funds because someone told you they're safe, but you don't know what's inside them, you're not investing. You're outsourcing. And outsourcing is fine until the system breaks, until the assumptions fail, until the crowd turns. Then you're not just exposed, you're vulnerable. So here's my advice. Don't abandon index funds, but don't worship them either. Use them wisely. Use them sparingly. Use them as a tool, not a religion. And most of all, think for yourself. Because the market doesn't care how old you are. It doesn't care how much you've saved. It doesn't care what you believe. It rewards discipline. It punishes emotion. And it exposes ignorance. So be disciplined. Be thoughtful. Be diversified. And remember, the illusion of safety is the most dangerous illusion of all. I've said for years that temperament is more important than intelligence in investing. And nowhere is that more true than with index funds. Because index funds don't protect you from yourself. They don't shield you from emotion. They don't prevent panic. They simply sit there, quietly reflecting whatever the market decides to do. And when the market decides to fall, index funds don't soften the blow. They deliver it directly, efficiently, without apology. Let's talk about behavior, because behavior, not strategy, is what determines outcomes. You can own the best portfolio in the world, but if you sell it at the wrong time, it won't save you. It'll punish you. And index funds, for all their simplicity, are not immune to behavioral mistakes. In fact, they often amplify them. Why? Because they feel safe. They feel passive. They feel like protection. And that illusion of safety is what makes them dangerous. When people believe they're protected, they stop paying attention. They stop thinking. They stop questioning. And when the storm hits, they're caught off guard. Let me give you a scenario. The market drops 25%. Headlines scream. Talking heads panic. Your retirement account shrinks. And you're holding an index fund. You tell yourself, it's diversified. It'll come back. But the fear creeps in, the doubt, the urgency. You start checking your balance every day. You start reading articles about recessions. You start wondering if this time is different. And then you do what millions of people have done before you. You sell. Not because the index failed, but because your emotions did. That's not passive investing. That's passive panic. And it's just as destructive as chasing hot stocks or timing the market, because when you sell low, you lock in losses, you interrupt compounding, you abandon ownership, and ownership is the only thing that builds wealth. Now, let's talk about herd psychology. Index funds are designed to follow the market, but when everyone owns the same index and everyone reacts the same way, you don't get diversification, you get synchronization, and synchronization is dangerous. It means everyone's buying the same thing at the same time. Everyone's selling the same thing at the same time. Everyone's reacting to the same headlines, the same fears, the same triggers. That's not investing. That's crowd behavior. And crowd behavior is rarely rational. In 2008, people sold index funds in droves, not because the companies inside them were worthless, but because fear took over. And when fear takes over, logic disappears. People didn't ask, is Coca-Cola still selling soda? They asked, how much lower can this go? They didn't ask, is Johnson & Johnson still making medicine? They asked, should I move to cash? And that's the trap. Index funds don't protect you from fear. They reflect it. They magnify it. They deliver it straight to your portfolio. So what's the solution? It's not abandoning index funds. It's understanding them. It's using them wisely. It's pairing them with discipline, with clarity, with emotional control. It's knowing what you own, why you own it, and what you'll do when the storm hits. Because the storm will hit. It always does. And when it does, your behavior, not your asset allocation, will determine your outcome. I've seen investors with brilliant strategies lose everything because they panicked. And I've seen investors with simple portfolios build fortunes because they stayed calm. It's not about complexity. It's about temperament. And temperament is what index funds don't teach. They don't teach patience. They don't teach resilience. They don't teach conviction. They teach exposure. And exposure without understanding is not safety. It's vulnerability. So if you're retired or close to it, and you're holding index funds, ask yourself, do I understand what I own? Do I know how it behaves in a crisis? Do I have a plan for when the market drops 30%? If the answer is no, then you're not investing. You're hoping, and hope is not a strategy. Let me leave you with this. Index funds are a tool, a powerful one. But like any tool, they can be misused. They can be misunderstood. They can be dangerous in the wrong hands. So use them wisely. Use them sparingly. Use them with clarity. And most of all, don't let simplicity become complacency. Because the market doesn't care how simple your strategy is. It cares how strong your discipline is. And discipline is what protects you when everything else fails. People think index funds are diversified, 500 companies, multiple sectors, broad exposure. It sounds safe. It sounds balanced. But when you look under the hood, you see something very different. You see concentration. You see distortion. You see a structure that's quietly becoming more fragile by the day. And if you're retired or close to it, that fragility isn't just academic. It's existential. Let's start with the S&P 500. It's supposed to represent the American economy. But today, it's dominated by a handful of companies. The top 10 stocks make up over 30% of the index. That's not diversification. That's dependence. And most of those companies, they're in tech. They're growth-oriented. They're priced for perfection. They're riding momentum, not fundamentals. So when tech stumbles, the index stumbles. When growth slows, the index slows. When sentiment shifts, the index shifts. And if you're holding that index, you're not just exposed to the market. You're exposed to its mood swings. Now, let's talk about how that happened. It wasn't manipulation, it wasn't conspiracy, it was math. Index funds are weighted by market capitalization. That means the bigger a company gets, the more space it takes up in the index. And when investors pour money into index funds, those funds are forced to buy more of the biggest companies. That creates a feedback loop. More money flows in, prices go up, market caps expand, and the index becomes more concentrated. It's not intentional, it's mechanical. But mechanical doesn't mean harmless, because when the top of the index becomes bloated, the bottom becomes irrelevant. Small companies get drowned out, value gets diluted, and the index becomes a mirror, not of the economy, but of investor behavior. Let me give you an example. In 2021, 5 companies, Apple, Microsoft, Amazon, Google, and Facebook, made up nearly a quarter of the S&P 500. That's 5 companies out of 500, and they're all in the same sector. They're all exposed to the same risks. They all move together. That's not diversification. That's concentration dressed up as simplicity. And when those companies stumble, as they inevitably will, the index doesn't soften the blow. It delivers it directly, efficiently, without apology. Now, I want to be clear, these are great businesses. I own some of them. I believe in their long-term potential. But belief is not a substitute for balance. And balance is what index funds are losing, because when everyone owns the same thing and no one's thinking, you don't get safety, you get fragility. And fragility is what breaks when the pressure builds. Let's talk about systemic risk. Index funds are now the dominant force in the market. They're not passive anymore. They're powerful. They move prices. They shape sentiment. They influence behavior, and that influence creates distortion. When a company enters the index, its stock price often jumps, not because it got more valuable, but because index funds are forced to buy it. When a company leaves the index, its price drops, not because it failed, but because index funds are forced to sell it. That's not investing. That's mechanical momentum. And mechanical momentum is dangerous when it becomes dominant, because it disconnects price from value. It disconnects ownership from understanding. It disconnects investors from reality. And here's the irony. The very thing that made index funds safe, diversification, is what makes them dangerous when everyone owns the same thing. You're not diversified. You're diluted. You're exposed to every sector, every bubble, every mispriced asset. And you don't get to choose. You ride the wave until it crashes. And when it crashes, you're not just exposed. You're synchronized. You're moving with the herd. You're reacting with the crowd. And the crowd doesn't think. It panics. So what do? You diversify, not just across sectors, but across strategies, across time horizons, across thinking. You own businesses you understand. You own assets that produce income. You own things that don't move with the crowd. Because when the index stumbles, you need something that stands. Diversification isn't about owning more. It's about owning wisely. It's about resilience, optionality, control. And control is the one thing index funds don't give you. They give you exposure, but they don't give you protection. Let me leave you with this. Index funds are a tool, a powerful one. But like any tool, they can be misused. They can be misunderstood. They can be dangerous in the wrong hands. So use them wisely, use them sparingly, use them with clarity, and most of all, don't let simplicity become complacency. Because the market doesn't care how simple your strategy is. It cares how strong your discipline is. And discipline is what protects you when everything else fails. If you're retired or close to it, your goal isn't to beat the market. Your goal is to not get beaten by it. And that means you need more than exposure. You need resilience. You need clarity. You need control. Because the market doesn't care how much you've saved. It doesn't care how old you are. It doesn't care what you believe. It rewards discipline. It punishes emotion. And it exposes ignorance. So let's talk about what actually works. You don't need 50 stocks. You don't need crypto. You don't need to chase yield. You need simplicity. You need income. You need peace of mind. That means owning businesses that make things people need, products people buy in recessions, services people use in downturns, companies with pricing power, strong balance sheets, and real cash flow. It means holding assets that produce income, dividends, rents, royalties, things that pay you to wait, things that don't depend on market euphoria to survive. It means building a portfolio that works even when the headlines scream, even when the crowd panics, even when the index stumbles, and most of all, it means tuning out the noise, because the noise is not your friend, it's your enemy, and it's louder than ever. Financial influencers, clickbait headlines, algorithmic panic. They don't care about your future. They care about your attention, your reaction, your fear. And fear is the most expensive emotion in investing. It makes you sell low. It makes you chase high. It makes you abandon ownership. And ownership is the only thing that builds wealth. So here's my advice. Don't follow the crowd. Don't chase simplicity. Don't assume the past will protect you from the future. Think, diversify, own what lasts, and remember, the safest strategy is the one you understand, the one you can explain, the one you can hold through the storm, because storms will come. They always do. And when they do, your behavior, not your asset allocation, will determine your outcome. I've lived through recessions, wars, crashes, scandals. I've seen fear win the short game, but I've never seen fear win the long game. So don't let fear make your decisions. Let wisdom do that. Let history do that. Let discipline do that. Because if you do it right, if you stay calm, stay rational, and stay invested in what matters, you won't just survive. You'll win. You'll protect your legacy. You'll preserve your dignity. You'll stay in control. I'm Warren Buffett. I've made mistakes. I've missed opportunities. But I've never bet against time, simplicity, or discipline. And neither should you. Index funds aren't broken, but they're not bulletproof. And if you want to protect your future, you need more than a basket. You need a plan. So build one, stick to it, and let the noise pass you by, because the market may be loud, but wisdom is quiet.